All right, so jumping back into notes, we talked last time about indexing and about the minimum wage and all that other kind of stuff, right? But we never really got to talking about the fact that the CPI is biased, right? So how is the consumer price index, or CPI, biased? So this ends up being a very important economic indicator, and it's discussed a lot, not just among academics and politicians, but it's discussed on the news, and it's because it has a lot of consequences, right? So a lot of things are indexed to the CPI, and so it's going to have some impacts on the bottom line for the government and for other people, right? But let's talk about the biases. So one of the important biases is that the CPI measures price changes, but not quality changes. What do we mean by quality changes? Well, let's say that you are an economist at the Bureau of Economic Analysis, and you're looking at the CPI, and you're seeing that, okay, PCs have 20% more memory, hard drive space, RAM, whatever, all of it, right? And they have a 20% higher price. So this isn't the same PC as the one with less memory, right? So do we record this as having a 20% price increase? So economists would actually say, no, this is there's been no change. The PCs improved by 20%, and they cost 20% more. But it's not that simple, right? So adjusting for quality is just inherently a very difficult thing. So why is it difficult? Well, there's a large number of goods and there are many subjective differences. In terms of what makes a pedicure better than a other pedicure, or what makes a haircut or something better than that, or what makes a gaming system better than a other gaming system, right? Some people would say that, oh, well, the classic stuff was way better or something, right? The days of Baldur's Gate or whatever the case may be, right? So it's just difficult. And the other thing that's really difficult, even more so than adjusting for quality, is how do you incorporate new goods? There's no base here. Think about how much did a computer cost in 1950, right? It didn't. It didn't exist. How much did an iPhone cost in 2003? It didn't. It didn't exist, right? So it's difficult for us when there are new goods. So the book uses the example about AIDS treatments in the 1990s, right? AIDS treatments, which is tangent, which is part of the reason why the coronavirus vaccine was able to be developed so quickly, was because of all the AIDS research over the last 30 years. But these AIDS treatments, they came about, and they really, really improved the quality of life and the length of life for these people that had AIDS. But it was like, how do you value these things, right? I mean, because that's the other, it's like, how much are you willing to pay to not die, right? Everything I have, and then some, right? And to go into debt. So, economists, they try to do things like they look at the next best thing, right? So they look at what was the treatment option before that. And they would try to kind of, use that as a, but it's not exact, right? Does not work very well. And so as a result, that, you know, there are biases in the CPI. We can't always use it as if it's this immutable, you know, law of nature. The other bias that we have is that the CPI uses a fixed basket. So we'll talk about this in a second. A fixed basket, that's B and A in one word. That doesn't work. Nope, don't convert. Basket of goods and services. So why is this a problem? Well, let's say that the price of coffee were to increase significantly, right? Well, a lot of us would switch to tea or, I don't know, soda or something else, right? We would get our caffeine from somewhere else. And so when the price of a good increases, consumers buy less and substitute other goods. So there's a great example in the book, like I said, about coffee and tea. If you're interested, please go through it. It's like a numerical example, but essentially failing to account for the substitution is going to overstate inflation. Which, I mean, kind of makes sense intuitively if you just think about the fact that, okay, coffee gets more expensive, the CPI is going to assume that you're still consuming the same amount of coffee, right? But actually you're going to be switching from coffee to something else. And so the CPI is going to be giving a overstated impression of what's going on with your general price levels, because assuming you're still drinking 5 cups of coffee a week when you probably are drinking 1 or none. You're probably drinking something cheaper. So again, there's an example there, but it would take up like 10 minutes, and it's really pretty intuitive at the end of the day. So the price level is the thing that we're trying to get at with the CPI, right? And so this price level is just that. It's a measure of the overall level. Seems like such a stupid definition of prices. It's like it's all in the name, the price level. And then when we talk about prices, a lot of times we will conflate talking about the price level and relative prices. So conflate is this fun word I like to use. It's confuse and think that these two things are the same or opposites, right? And so back in the 1970s, there was a period of, or 1980, there was a period of really high inflation. And there was a public poll, right, that they did, and you know, in the dramatic way that they did back then in the 1980s and 90s, right? You know, they were like, what's public enemy number one? And everybody said it was rising prices. It was inflation, right? But then they didn't really have a very good understanding of actually what that was. And, you know, we saw this again in the mid-2000s when it happened with oil prices. So there are going to be times where there's isolated increases in something, right? So the relative price is the price of a specific good in comparison to essentially the price level. So a lot of times people will be saying, "Oh man, we got to get this inflation problem under wrap," but it might just actually be, you know, political disagreements in the Middle East, or, you know, unrest, or OPEC is fighting or something, right? Or OPEC has agreed that they're going to limit production even more, right? So there's a cartel in the Middle East between a lot of the oil producing nations, and they come together and they say essentially, we know what the demand curve is. We know if we issue this many barrels, the price is going to go up to this. Let's do that. That's gonna benefit all of us, right? And depending on what's going on, depending on where they are on the demand curve, it may. So we just got to be careful when we're talking, in economics, right? When we talk about the price level, that's all of the prices, right? There's thousands of goods and services that we buy each and every day, not just gasoline, not just what the price of milk has gone up, right? You guys probably noticed that. And so this is a ratio, whereas the price level, that's an index. And so if there's a doubling of the gas price, right, but the overall price level, inflation only increased by a large amount, there'd be a very large increase in the relative price of gasoline, which is part of the reason why we exclude gasoline and food prices from most of our inflation measures. So we have inflation, and then we have core inflation, and core inflation strips away the oil and the food stuff because they're so erratic. So these relative prices, they can change a lot without corresponding changes in inflation, the overall rise in the overall price level, right? And there's seasonality in a lot of this stuff, right, which we don't always understand, right? So when we look at summer prices, so some things are more expensive in the summer, right? So beach hotels, cruises, gasoline is more expensive. Why? Because there's a different mix of gasoline needed for hotter weather compared to colder weather, and it actually takes more crude oil. So gasoline, I'm thinking gas prices. And then in the summer, we've got some things that are lower in price, right? So fresh fruits and vegetables. All of a sudden, you're like, wait, what? Strawberries are like $1.50 for a package? What's going on there? They were like $5 3 weeks ago, right? So when they're in season and there's a crazy glut, right? When there's a bumper crop, the price is going to go down. Heating oil. It's lower in the summer because less people are using it, right? So important to keep that in mind, that there's a fluctuation, a seasonal fluctuation in the prices of things, not just having to do with holidays and Black Friday and the fact that we spend like half of our incomes in that like 1/4 of the year or something nuts, right? So we spend a ton of money in Black Friday and the holiday season, but we also spend a ton of money in the summer, right, because of vacations, so on and so forth. All right, so at the end of the day, why do we care about this stuff? Well, we care about it because prices are the main signals that are giving information to different companies so that they can coordinate their activity. So the book talks about, New York and the amazing, how all of the food gets to all of the different, patisseries and, all the different little shops and the really nice places and the street vendors, right? How does it all get there? It gets there through the market system rather than some ministry or some bureau coordinating all of that economic activity. And and that coordination happens through prices. So if you are a high-end chef and you can't get any specialty chanterelle mushrooms, right? You're going to bid higher. You're going to, tell your supplier, hey, I need, I'm willing to pay more. And that supplier is going to talk to their person, and they're going to see this profit opportunity, and they're going to go ahead and they're going to go forage for more chanterelle mushrooms because of the fact that it's at a higher price. They're more likely to go and gather and sell more of those, right? And so it's transmitting information both about the cost of production, but also the value that buyers place on an additional unit. So there we are again talking about an additional something, right? Because that's economics. It's about the margin. Incremental analysis. We're talking about an additional one. And so if prices are transmitting all this information, well, what the heck does inflation do? Well, inflation gets in the way. So just like when we're listening to a radio and all of a sudden we don't get very good reception, there's all the static on the radio, there's noise, right? So in the same way, inflation creates static or noise in that communication. So now, if there's a lot of inflation, the buyers and sellers of the chancerelle mushrooms, they can't tell whether the relative price of their good is increasing or if inflation is just increasing everything, right? Can't tell if it's the price of all goods and services increasing or it's the relative price of their good. So if there's a lot of inflation, this transmission of information is not going to be as clear, and there's not going to be as much of a response to it. So in order to decide these issues, you've got to gather information. That takes time, it takes energy, so there's a cost to it. So responding to these changing prices can be tentative and can be slow. So, pardon me. So indexing, we've talked about before, right, is beneficial. Why is it beneficial? It also avoids distortions. What do we mean by distortions? Well, let's think about if there's a lot of inflation. Let's say your income increases by $20,000 and the price of everything increases by a corresponding amount, right? Well, you would then be in a higher income tax bracket. You would be getting taxed more as a percentage of your income, even though you're not actually purchasing, you're not able to purchase anything more than you used to be able to purchase. So we have indexed these income taxes to avoid what I just talked about, which is bracket creep. So there's a lot of different terms that are blank creep, and it talks about, it's not like a creepy person, right? It's not the song creep. It's about something that is like, you know, sneakily coming up on you, and it's there before you notice it, right? And so I know the word creep as part of the word scope creep. So I do a lot of independent consulting, right? Because I'm in a ton of debt, and, you know, teaching pays pretty well, but, you know, it's not amazing. So I do a lot of consulting, and you have to really control, like, here's what I'm going to do, because otherwise, if somebody pays you, you know, $2,000 or something, they're going to have what's called scope creep. So there's going to be a increase in the scope of work. They're going to be like, oh, but can you do this thing? Oh, but could you also do this thing? Could you do like a scenario analysis that's like all 4 of these? And you're like, that's like redoing the thing 4 different times. Like, are you serious right now? So you have to be really clear in terms of when you're writing these contracts, here's the scope of my work. And so scope creep is a thing that, you know, if you guys end up doing any independent work, you may have, unfortunately, you may have some, you may encounter, right? So bracket creep, let's go ahead and define bracket creep, because we have to write stuff down. I have to write stuff down. If I don't write it down, almost all of you don't write anything down. So bracket creep occurs when a household is moved into a higher tax bracket and this is due to increases in nominal but no increase in the real income. real world neo. And this is important because, like I just said, I mean, it's not something that we probably know because we haven't had to do a lot of taxes, right? But higher tax brackets have a higher effective tax rate. So, you know, when I was in undergrad, I would look at my paycheck and be like, okay, like 20% of this is going to be taxes. Now it's like more like 30%, right? So you make more money, they start to take more and more. You get to a certain level, I think it's like what, 40 something? It used to be like 80 or 90. Like it used to be like after like $5 million, they were like, you don't really need all that. Like we're just going to take most of it. And there was still a lot of entrepreneurial activity and economic activity and things like that, right? But that was 50 years ago, in the heyday of us actually increasing taxes when we need to increase taxes, unfortunately gone, which is part of the reason why we're in the debt mess that we're in. So speaking of distortions caused by taxes, that's our next subject. Distortions that are caused by taxes. So not all taxes, hashtag not all taxes are indexed. So let's just talk about one specifically right now that the book does a good job talking about as well, which is the capital depreciation allowance. So depreciation is this accounting term which essentially just means that as my equipment starts to fall apart, right? As it grows old and starts to be useless, right? So like this Microsoft tablet here, it was like the cheapest one that I could buy 2 years ago, and it crashes all the time when I'm trying to like record and do the thing, right? So it's depreciating pretty quickly, and in another year or two, it's going to be a paperweight slash what I'll probably do is I'll probably like have it be like a slideshow photo frame thing, you know what I mean? Like it's going to be useless though, right? It's going to be useless in a couple of years. So capital depreciation is this thing, and the allowance, so the allowance by the government is this thing that encourages the purchase of capital goods. So remember, capital is not the capital of a state, right? It's the machinery, it's the equipment, it's buildings and things like that, right? So this desk is capital, this computer, the projector, the screen, all that stuff is capital, right? And so this capital depreciation allowance is because Congress wanted to stimulate economic growth and stimulate investment, right? And so what does it do? It allows firms to deduct a share of the capital purchase, right, the purchase price, as a business expense. And when you deduct things as a business expense, that means that it's essentially, it offsets any income that you will have to pay taxes on. So it's not a one-for-one in terms of like, if you owed $500 of taxes and you could write off like $500, you don't then owe them zero. It's the fact that it's less money that you're being taxed on. So it's like, if you made $10,000 and you could depreciate something for $500, you would only be taxed on $9,500 instead of the full $10,000. So it's not amazing, but it's still better than nothing, right? And so it really does incentivize, catalyzes businesses to purchase things, right? So, let's say that a business purchased a machine. If the machine cost is $1,000 and the useful life is 10 years, and the IRS and those people, they have like a list of things. They're like, okay, computers, 5 years, this kind of stuff, 10 years, this kind of stuff, 3 years, right? So this means that essentially you just take this $1,000, you divide it by 10, right? I have a capital depreciation allowance, of $100 a year. Now, what happens if there's high inflation? So if inflation is high, then my $100 in year 5, 6, and 7 is not worth as much in terms of what it can purchase, its purchasing power, right, as that same $100 in year 1. So we found that in periods of high inflation, investment in plant and equipment, so capital stuff, right? Plant and equipment decreases. So the capital depreciation allowance is not the incentive that it was before to go ahead and purchase and invest in that. Also, whenever inflation is really high, making any kind of business decision is tough, right? Because prices are changing, and you don't know if they're going to keep changing, and you don't, they might go up 10% this month, and they might keep going up at a rate of 10%, or they might, go down or something. They might stop moving at all, right? So keeping inflation steady and low creates a good business environment so that people can make decisions confidently. So, if we had zero inflation, then cash would hold its value. Now, we know that some cash will always be held for convenience. Walking around money, right? You need some walking around money. But when inflation is high, cash loses its value over time. So we manage these cash balances that we have to limit the losses. So when there's a lot of inflation, you might take smaller withdrawals from your money mutual fund account or something like that. There's going to be a cost of inflation, both in the fact that banks are now going to have to process more transactions, so they're going to have to hire more clerks and stuff like that, right? And then the book talks about shoe leather costs, which is a fun little term. Referring to the cost of frequent trips to the bank. So we're going to talk about this in a minute, but there was a time in Germany where hyperinflation was so bad that they would pay people twice, once in the middle of the day, so that they could go and they could buy food for their family before the price increased at the end of the day. Prices were increasing at an hourly rate. And so these shoe leather costs, right? This is the time that it takes to go to the bank. But I mean, you also have you've got companies that have to do this, right? So you may be paying somebody just to take cash to the bank. And in fact, when I was doing consulting and things like that out in California, and I was working for some of the medical marijuana places and stuff like that, they literally had that. They had somebody that was just their cash runner, because they couldn't have bank accounts and stuff like that, right? And they had all this cash, and so somebody's job was just to go to different convenience stores and buy money orders with this cash, because that was they needed to pay their bills. They couldn't send a stack of cash to the electric company. So, and then essentially, if you go to someplace too much and do this, then they're going to be like, you're laundering money. You can't do that anymore. And so they'll just cut you off. So if you like start going to the Circle K like every day and get money orders, they're gonna cut you off. So they had to go to different places. So so these are real things that happen even to this day, and yeah, could happen again. So one of the cool things about inflation, right? So right now we're experiencing an annualized rate of inflation of about what, 5%, right? So it's not that high compared to normal. Normally our inflation rate's 2-3%. We've actually experienced like pretty steady prices in the last 10 years. So we haven't had really any. It's been like 0.5 to 1 or whatever, right? So that's why it seems like it. But again, at the end of the day, it's not that bad. And there's a positive benefit to higher inflation in that it redistributes wealth. So unexpected inflation redistributes wealth. So what does that mean? That means that it is it's a zero-sum game, and somebody is gaining purchasing power and somebody's losing purchasing power. That's the way to think about it. That's what redistributing is. So it's not that wealth is growing. Inflation doesn't generate wealth at all, but it may create some winners and losers to the wealth gain, if that makes sense. So let's do an example. So suppose that workers' salaries are not indexed, because most of the time they aren't, right? Think about your salary, not indexed. My salary is not indexed. I mean, we go and we negotiate every 2 years, but and the fact that inflation has been higher means that when I go to negotiate as part of the faculty union, right, I'm going to bring that up as part of the information. Like, look, cost of living has increased. So we're going to need more than we got last time because the salaries lose purchasing power. The amount of stuff, the amount of goods and services that I can get with my salary has decreased because of the fact that everything's more expensive. And so in this situation, like I said before, it's a zero-sum game. So this situation is employers gaining at the expense of workers. Similarly, unexpected high inflation will benefit borrowers at the expense of lenders. Not the people that make bagels, the people that loan money out. So how is this redistributing between borrowers and lenders? Well, let's think about it. If I borrow $300,000 and inflation increases at a rate that neither me nor the bank anticipates, then the money that I'm paying back the bank has less purchasing power, right? So me as the borrower, I get to repay my loan with dollars that are worth less. Cannot spell or write today. This unexpected inflation it really gets in the way of just simple economic incentives, right? If you work hard, if you save, then you're going to be able to have enough money for retirement, right? And so inflation kind of screws with that. So as a result, it's important for us to manage inflation, be aware of what's going on, put pressure on the Federal Reserve to take action when they need to take action. Because inflation, unexpected inflation, will interfere with long-term planning. So think about it. If you have a long time horizon decision, erratic inflation makes any sort of planning risky. Retirement planning, right? Something that the sooner you get on, the sooner you start setting money aside, the easier it's going to be, because, you guys are 10, 15 years younger than me, right? That's 10 or 15 extra years of that money compounding in interest. And so retirement planning, so just plant that seed there. Even if it's like $50 a month, I highly recommend that you guys start thinking about that. Unless you want to work forever. Which, if you love your job like I do, then every day feels like I'm not working. So you have to have an estimated cost for your desired lifestyle, right? So the book starts off this chapter by saying, well, what if you retired with $100 million? Would you have enough money to survive, right? And, the answer that all of us immediately say most of the time is yes, right? But we have no idea what's going to happen with prices, right? We have no idea if the cost of a house or something is going to be $1 trillion in the future, right? $100 million isn't that much if, a typical meal is going to cost $3 million, right? That's 33 meals, right? So if the prices increase dramatically, then this money that we've saved, right, is not actually going to provide everything that we hope it to provide, right? And so if we save too little, then we live less well in the future. Whereas if we save too much, we live less well right now. And so given the cost of inflation, most economists agree low, stable inflation is the goal. Promotes a healthy, happy economy. And so to see some examples of this, right, we need only look past some of those buzzwords in that TikTok, right? So one of them is hyperinflation. Hyperinflation, this is extremely high rates of inflation. So like I said, in Germany in 1923, the workers were paid twice a day. You're going to minimize your cash holdings. There's a lot of cost of inflation when it's that severe. Literally, like, you have to have somebody whose job it is to go change the prices. I mean, nowadays you got all those digital prices, right? It's like corporate McDonald's can just be like, boop, boop, boop. Cost of this increases, and it just, boom, increases for the whole world, right? But back in the day, even then, though, you got people that have to manage that. You got somebody that's got to do it. It's got to make sure. Somebody's got to troubleshoot it, so on and so forth. So we won't get into hyperinflation too much. There's a lot of videos, YouTube. Have fun. All right, so inflation and interest rates, our last topic of the day. So we've already established unanticipated inflation will help borrowers and hurt lenders, right? So how do we deal with that? Well, there's this really neat thing called the real interest rate. So let's define it. It's the annual percentage increase in the purchasing power of financial assets. So not cash, right? And so in order to get our real interest rate, we go ahead and we take our nominal interest rate. So the nominal is just the annual percentage increase in the dollar value. So if I told you I'm going to borrow something, I'll pay you back at the end of the week, or at the end of the month, I'm going to borrow $100, I'll pay you back $10. My nominal interest rate would be 10%, right? 10% of 100, that's what I'm going to pay you in interest. That's the nominal interest rate. So my real is you take that nominal and you subtract inflation. And so the book has a fun apply the analysis, right, where it talks about how, you know, the nominal interest rate in 1975 was 5.8. So if you took a loan, you had to pay 5.8%, right, on whatever that amount was. So if you took a loan for $100, you had to pay $5.80 on that loan at the end of the year. The inflation rate for this period was 9.1. So your purchasing power was eroded more than the nominal interest rate, right? So when we go ahead, when we subtract that inflation rate from the nominal interest rate, we get a negative 3.3% for our real interest rate. So if we took a loan out during this period, we didn't have to pay for the loan. We got paid for the loan, right? So the real interest rate is really what matters, because it's talking about how much purchasing power has increased or decreased. All right, that's it for chapter 6. If you guys have any questions, please send me an email. I will be here around on Friday if you want to meet up. If anybody wants extra office hours or something, please go ahead. You know, take a look. Don't wait till Sunday to take the exam. Right, you have 2 attempts. Use the first one as a study attempt. I'll take the best of both of them. Best of luck. Have a good weekend.